Polkadot currently operates with a massive structural deficit, hemorrhaging over $300 million in negative earnings over the past year. The network is widely considered a ghost town by retail participants, boasting a mere 43,000 monthly active users and processing an abysmal 2.2 transactions per second. Yet, while the broader market laughs at these lagging metrics, sophisticated capital is quietly positioning for a violent supply shock. The data reveals a massive, fundamental economic reset occurring right now, completely redesigning the tokenomics for long-term scarcity. Miss this transition, and you ignore one of the most asymmetric risk-to-reward setups currently forming in the digital asset space. Today, I'm going to show you exactly what the on-chain data reveals, how this new economic model fundamentally changes the valuation, and precisely where my bids and hedge shorts are placed on the weekly chart. The current price action places Polkadot in a heavy consolidation zone, fluctuating tightly between $1.30 and $1.70. Market sentiment surrounding this asset is practically non-existent, largely because the retail crowd fundamentally misclassifies it. They are constantly comparing Polkadot to newer, high-throughput Layer 1 competitors, completely ignoring the reality that DOT is a foundational Layer 0 infrastructure, the underlying bedrock designed to secure, scale, and connect entire ecosystems of other blockchains. However, to understand why this specific moment matters, we have to look at the broader macro environment. Bitcoin ultimately dictates the liquidity flows for the entire market. We have been witnessing since last year a major drop from the highs, hitting a selling climax that successfully paused the downtrend. What followed was a massive 24% rally, bouncing aggressively from $60,000 all the way up to $74,000. This rapid recovery clearly demonstrates that institutional buyers are highly comfortable absorbing supply at those lower valuations. Right now, Bitcoin needs to hold the $70,000 level as critical support for market continuation. This macro stability sets the stage for capital to rotate outward into infrastructure plays. But for Polkadot to capture that liquidity, we must look past the dismal retail sentiment and focus directly on the developer activity. Despite the lack of users, developer commits remain exceptionally robust, printing 7,900 commits over a 365-day window. The infrastructure is being actively, aggressively upgraded. I'm seeing a massive, quantifiable disconnect between the suppressed price action and the fundamental protocol advancements. I'll show you why this matters in the chart shortly, but first, we need to address the catalyst that changes everything. Let us analyze the actual on-chain and fundamental data. The old economic model was highly inflationary, actively bleeding capital through excessive token incentives that failed to drive sustainable user growth. But the network just initiated an aggressive economic reset. The token supply is now hard-capped at 2.1 billion, and emissions have been immediately reduced by 53.6%. Furthermore, the arbitrary treasury burns have been eliminated and replaced by a highly efficient dynamic allocation pool. This is a textbook structural supply shock. When you combine this drastically restricted issuance with the fact that 52% of the total supply is currently locked in staking contracts, you get a severely illiquid circulating supply. That staked capital is earning an average reward rate of 11.5%, serving as an attractive anchor for passive, yield-seeking capital. But the friction of developer onboarding has always been Polkadot's bottleneck. The native Polkadot virtual machine proved too complex, hitting a wall regarding adoption. That changes with the full integration of the Ethereum-compatible environment. This frictionless bridge allows the massive global pool of Ethereum developers to deploy their complex smart contracts directly onto Polkadot without learning a new architecture. Simultaneously, we are seeing the financial plumbing being laid out. The stablecoin supply on the Polkadot Asset Hub has increased by 25% over the past 6 months. Rising stablecoin dominance is a leading indicator of capital retention and future decentralized finance total value locked. The ultimate catalyst, however, bridges traditional finance with this new scarcity model. We currently have active filings for spot Polkadot exchange-traded funds from Grayscale and 21 Shares. The 21 Shares ticker is already listed on the Depository Trust and Clearing Corporation for operational readiness, with a final regulatory decision expected in the first half of 2026. This gives us a definitive timeline to front-run institutional capital inflows. Now, let us transition to the technical breakdown. We are looking at the Polkadot weekly chart, and the market structure here is highly compressed. Price is currently trapped inside of a massive falling wedge pattern that has been developing since September of 2025. The price action is getting tighter and tighter by the week, fighting to make a definitive decision right at the descending resistance line. From a trend perspective, we are currently trading below the 21 exponential moving average, which is the red line, and the 200 simple moving average, which is the green line. This confirms the macro trend is still heavily suppressed. However, we found support around the 2618 Fibonacci extension level, sitting at $1.37. My Fibonacci levels were anchored from the $3 low in June of 2025 up to the $4.88 high in September of 2025. That $1.37 level aligns perfectly with the lower boundary of our falling wedge, creating a high probability bounce zone. If we look at the momentum oscillators, specifically the Fibonacci Relative Strength Index, located below the price action, we see a clear bounce originating from the extreme oversold region. The indicator is now pointing upward and has formed a confirmed bullish divergence when compared to the descending price action of the asset. I have also plotted a descending trend line on this indicator. A breakout above this line will signal a definitive macro trend reversal. Now here's exactly how I'm structuring my position. I won't make any emotional decisions on my short-term bags until we get a weekly candle close that definitively breaks this falling wedge, either upwards or downwards. If the price breaks the wedge to the upside, I'm immediately buying more to expand my long position. Our first major resistance and take profit target to the upside is the 1618 Fib extension at $2.20. Beyond that, I'm scaling out at $3.60, $4.80, $7.50, and finally, $11. But risk management is non-negotiable. If the price breaks down below the wedge support, I'm opening a hedge short position upon the retest of that breakdown level. This hedge is designed specifically to protect my long-term spot position, which I refuse to liquidate at these depressed valuations because it represents a calculated, small portion of my overall portfolio. If that short setup triggers, my downside take profit targets are 85 cents and 65 cents. For those who are overly exposed or stuck with massive positions in this asset, taking some risk off the table right here at the wedge resistance is a mathematically sound approach to capital preservation. My primary time frame for these higher upside targets spans up to 18 months. To protect capital along the way, I utilize a strict trailing stop system for both the long and the short scenarios. If we achieve the first take profit target, my stop loss is immediately moved to my entry price. When the second target is achieved, the stop loss advances to target 1, and so on, systematically locking in yield and eliminating downside exposure. This synthesizes the fundamental and technical data into a coherent game plan. The fundamentals dictate a network transitioning from hyperinflation to forced scarcity. The technicals show a highly compressed asset sitting on major Fibonacci support. If the structure breaks down, the hedge short covers the portfolio risk. If it breaks out to the upside, the price will eventually have to confront two major descending trend lines. The first coming from the local top in December of 2024 at $11, and the ultimate macro trend line originating from the 2021 all-time high of $55. So, Polkadot is fundamentally fixing its economic engine, while the technical chart forms a high-tension compression pattern that demands an imminent resolution. Capital preservation combined with calculated exposure is how you survive and thrive in this market environment. If you found this data-driven analysis valuable, please hit the like button and subscribe to the channel. For faster daily market updates and real-time trade setups, I invite you to join my free Telegram group. You'll find the direct link in the pinned comment below. I also highly recommend that you watch my last two videos about Polkadot on this channel to catch the full story and understand the previous developments that led us to this exact setup. As always, please remember that this analysis represents my personal market strategy and does not constitute financial advice. Protect your capital, respect your invalidation levels, and let the data dictate your decisions. Thanks for watching, and I'll see you tomorrow in the next one.